The Federal Reserve raising their interest rates is having a trickle-down effect. Maybe not the way they had hoped, but it's impacting inflation, it's impacting the stock market, and it's impacting real estate. We're going to dive into that next.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hey, welcome again to the Trending Report. Today we're going to dive into interest rates. We're going to dive into inflation again and how that's impacting the real estate market, and then obviously how it's also impacting the stock market as well as the bond market in our normal trending approach. We will be again using data from last Friday. That would be February 24th. So let's dive in. Now, here we are on the upper left-hand side with the United States inflation rate. And as you know, going back here to 2020, inflation has been increasing. We peaked out right here at about 9%, a hair over 9%, if I recall correctly. And as of late, we are down here in the sixes. But look at this little tail that we're starting to get as of January. And this is what has the Federal Reserve making statements as we basically speak now, along the lines of the fact that they need to keep increasing interest rates. They're not going to necessarily be able to slow down, stop, or turn back the other way at this point in time. And that's made the market a bit jittery because over here on the right, we have the Fed funds rate itself. And as you can see, we're basically at zero for quite some time here. And then as inflation hit, the feds started to crank on their primary tool. There's not a lot of tools in that toolbox right now. They started to crank up interest rates. The idea being that they want to cool off inflation. Cranking up interest rates affects all kinds of different things. And like we talked about last time when we shared some time together, we went into the jobs market. Today, we're going to go into the real estate market in terms of how all of this interconnects together. Because obviously they've been increasing interest rates. Over here, it seemed to be working, but then we get this little flat spot, like I mentioned a moment ago. And what they want to make sure is that that flat spot isn't the same as this flat spot or this flat spot here, that it is in fact going to continue to taper down on inflation. But at the same time, if you're rising interest rates or increasing interest rates here, you are going to have an impact down over here, which is where it really truly affects people on a daily basis. Here we're looking at the 30-year mortgage rates, the average rates. And as you can see, they've been jumping up quite a bit. Now, again, everything always needs perspective. So many people are thinking, wow, interest rates are really high on mortgages. But keep in mind, they used to be, if you go back in time enough, they were double digit. My first home with my wife and I, we had a double digit mortgage. In fact, it was about double where we are right now. It was in that 12 to 14% range, if I remember correctly. And here we are again today, coming in below 7, but well north of 6%. So call it 6.5, 6.6, 6.7% on the interest rates on mortgages. So everyone knows we've been in this hot real estate market that took off during the pandemic for a whole host of different reasons. But again, the impact on the real estate market is eventually going to kind of catch up with these interest rates. And now we're starting to see some of that. So it's still a fairly revved up market, but it is cooling. So if you're looking, again, this is a longer term graph here, but look at this little downturn right there. And this is looking at the housing market valuation losses. And then this correlates down to this percentage drop right in here, this 6.5% drop. The last time we saw a 6.5% drop like that was back here in the financial crisis. Now, again, we are not below the zero line here, as you can see, like we were back here. So we're not going negative in values on homes, but the increasing is not, the year over year increasing is not continuing. So this is what this is illustrating for you is year-over-year change. So we're not seeing negative numbers on the year-over-year change like we did here, but we are seeing the sharp decline, which again correlates back over to this increase, which correlates to this increase, which is happening because we're trying to drive this down at the Federal Reserve level. So all of these things interconnect. And next, we want to look at how is this now currently impacting the stock market. So when we look at our normal trending, here we're looking at U.S. capitalization. This goes everything from small cap up to large cap, and what the various subsets of the market look like, be it value or growth, but within those capitalization segments. What we're seeing is that if this is the overall representation of the stock market, thanks to the Vanguard stock market, total stock market ETF, what we're seeing is in the really short term, in the nano, we see a lot of red. This red means we're tilting bearish, and yet it's correlating against all of this green that we see here. So the market itself, we don't know if this red is going to be a short-term bump in the road, and we're really going to see the longer-term trending continue to win the day, or if this is the beginning of a turnaround towards the bearish. But right now, the tilt, which is the overall scoring from macro all the way down to nano, the tilt is showing green all the way down the scope of the various capitalization sections. Excuse me. So here what you see at the top is the small and mid cap are really winning the day. Small cap 600 value, 400 mid cap value, the overall 400 index, the 400 growth, and then here's the overall 600 index, which is the 600 small caps, and so on. But then down here, we've got the S&P 500 and the S&P 100 being the large caps. So the large caps are kind of dragging the market down, and right now the small and mid caps are kind of buoying the market up. So again, from a macro perspective, we had all of this red followed by this green. So this is the red coming down, and here's this green coming back up. But most particular, we've got this nano right here, this red drop that we're looking at and discussing as we look into this. So now let's take a look at how this breaks down, same market, but from a sector standpoint. So in the sectors, you have 11 different sectors, and that makes up the overall market. So really what we're looking at is the not dividing down by large cap versus small cap, but dividing down by the various sectors that the businesses and the stocks they represent are within. So here, if we have equal weighted sectors, you're in the middle, you're still green, but beneath it now we are seeing red. And we're seeing this nano column all red again, like we mentioned a moment ago. But up here, we've got information, industrials, telecom, financials, consumer, and materials buoying up the market, dragging it down, consumer staples, healthcare, energy, utilities. And then right here, REIT, that's your real estate that we were talking about a moment ago. So again, here we are with this little red downturn. Looks very similar to the previous chart. That's the nano downturn taking place right here. We don't know if this nano will be the beginning of a glimpse to the future or if it's just kind of a speed bump along the way. Again, going to be yet to be seen. Bonds, on the other hand, bonds are turning bearish. We're seeing a full column of nano and micro as red in the bond market. We're also seeing the overall tilt coming in as red as well. So what that means is that the red micro and nanos are kind of overpowering some of the green we're seeing over here to the left. So we are starting to see that tilt is coming in red right in here, then being led by the nano and kind of dragging along at the macro level, but you can see how it's kind of curving its way back down here. And interestingly, we've got corporates are buoying up the bond market, and it's government bonds and treasuries, so to speak, that are dragging or pulling down on the market right now. And then finally, we take a look at international. International is starting to look quite a bit like the US right now. We've got a column here of red at the nano. That's the closest, kind of lowest altitude view of things, versus all green out here on the macro, which is the highest altitude view. And we're showing the total international stock market is coming in with a tilt towards bullish. It is a positive number here in the green. And excuse me. And yet we did go through the same kind of red down here. So this is coming down this way. We saw the same macro red taking place with all of this downturn. And then we see the macro going green. That's this upturn. And then right here is our nano drop. Just like we were seeing before, here's our nano drop. So maybe even a little more severe over here on the international side. Again, not sure if it's going to be an indicator of things to come or if it's a speed bump along the way. But both the U.S. and the international are kind of in tandem with the nanos reflecting bearish right now. And we even saw that in the bond market with that reflecting bearish as well. So we will continue to monitor this. There will be continued pressure on the Feds as of right now. They do plan to keep raising interest rates. They do believe they need to kind of keep a stiff upper lip, so to speak, in terms of holding to it because they want to subdue that inflation rate. And as much as it pains me to say it, they don't really have any other tool to use in that toolbox other than interest rates right now. So as tough as that can be on your lending and your credit and having higher interest rates on mortgages, as tough as that can be on the job market, to trying to kind of squelch and want to see that the job market is getting subdued in tandem with inflation getting subdued. So that's a tough pill to swallow. But nonetheless, the Feds need to get that inflation in check. It has taken a little bit of a downturn, but it's not dropping the way they would like it to. So we'll keep watching this as we move forward. Thank you, everyone.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.